Greetings, friends. My name is Weston Nakamura from Blogworks Macro in Tokyo. It is Friday, May 12th, 2023 at Asia Markets Close, and welcome to the Market Depth Podcast, bringing you global market commentary and analysis from the Asia-Pacific trading session so that you know what happened overnight. Today, we are going to take a look back at this week in global macro out of Asia, starting with the latest wave of data out of China, where CPI is basically at 0% year over year. China PPI plunges to a 3-year low, and then we also have aggregate social financing and credit growth that's falling. Then we are going to take a trip over to my neck of the woods. Well, not really, but close enough. Niigata, Japan, where the G7 finance ministers and central bankers have gathered in my neck of the woods to discuss whether or not the United States will pay its bills. That's going on right now as we speak. And then we're just going to do a kind of quick markets follow-up from the earlier episodes of this week, as the Chinese financial stocks frenzy did indeed hit that brick wall, and they've been falling ever since, and they've been dragging the entire region down for the rest of the week. That is with the exception of Japan, whose equities markets continue to be very resilient into the end of the week. And so this long Japan, short China divergence is really kicking into gear. And so we know what's pushing the China markets down. What's uplifting the Japan throughout all this? It's single stocks earnings strength. And so I'm going to follow up with the post Nissan and Honda earnings rally to end the week, as the number 2 and number 3 Japanese automakers surprise estimates and full year guidance and their production outlook because semiconductor chip shortage has now eased. And if you recall, this is exactly what JFE Holdings, the steel company, the steelmaker, had explicitly said just 2 days prior in their earnings, essentially leaking the Nissan and Honda earnings calls, for which the markets clearly didn't hear because the stocks rallied 5% each into the close today on heavy volume. And then to end all of it, going into the weekend, I am going to dive into the always very comical, very unique, but very serious and critically significant company known as SoftBank and their Vision Fund, which posted yet another full-year record loss. I've been thinking that actually, because SoftBank really does deserve its own separate episode. So that's what I'm going to do, and so I'm just going to give a quick gloss over today and just do SoftBank separately because it deserves its own separate thing. But either way, that's what's on the menu for today. A lot to cover, so despite everyone and their mother complaining about how fast I talk, this time it is for function. First, China CPI comes in at 0.1% year over year, okay, which is the slowest rate in 2 years. And that very well may be yet another measure of weak domestic demand, and we're going to get into that in a second. But we also have PPI, Producer Price Index, which is the wholesalers. PPI plunged to minus 3.6% year over year, far worse than consensus expectations of a 3.2% drop. And now this is now 7th consecutive month of declines in PPI. And this, too, is the sharpest fall in about 3 years. Okay, so CPI, 2-year lows, PPI, 3-year lows. What's going on, China? I thought that we were reopening after scrapping, zero COVID policy and all that, right? Okay, well, let's just take a, quick look under the hood a little bit deeper. So a lot of this week inflation is due to falling commodity prices and energy prices. Because if we look at China's core CPI, which is ex fresh food and energy, that's up 0.7%. But that is still flat on a month-over-month basis. So trend-wise, it's not like it's making progress either. So the energy component, which is coming off of a very high base rate from the crude oil surge in the first half of 2022, that's hitting CPI down for sure. And that will likely continue for the next few readings, simply, off of like base effects alone. Now, services inflation, as well as items like clothing, those aren't actually falling. And so there you see the China reopen-driven price support. But the lower energy, the fresh food prices coming off of like the high base effects, that's basically negated any of the reopened services spending. Okay, or another way to say it would be that the reopened spending drive is not enough. It's too tepid. It isn't enough to overcome the base effects of the commodity prices falling. Okay, so CPI and PPI in China are both falling. How much of it, though, is actually the weak demand story versus the base effects driver, right? So what else can we glean from other data? Well, we also have China credit data, namely total social financing. Okay, in other words, aggregate financing, which is just another broad measure of credit. And we also have new loans data. And so aggregate financing came in at 1.22 trillion yuan for April, which is a pretty sizable miss from the estimates of 2 trillion yuan, and a very big drop from the previous 5.3 trillion yuan just a month prior. Okay, so there's that, right? And then let's look at new loans. New loans offered by financial institutions was 718 billion yuan, which is basically half of where consensus estimates were. Consensus estimates were at 1.4 trillion yuan, and the actual was 718 billion. So, if you tie in this weaker than expected credit growth, credit demand back to, the weaker than expected CPI and PPI, all this in aggregate and combination, it seems to point to indeed a weaker demand picture that's driving inflation, rather than just blaming high base effects, measurements, right? The reopen gusto is coming in weaker than consensus Western economists had been expecting and had been looking for initially. Okay. Now, the question is, in the face of a downtrend in both CPI and PPI and weak domestic demand and economic uncertainty, lower credit growth, all that kind of stuff, right? In the face of all that, what will the PBOC do or not do? Will they provide additional stimulus to support a potentially fragile but recovering consumer? It seems to be like there's a very big split right down the middle, in terms of at least Wall Street economists over that very question, right? You have it really is like 50-50. You have some calling for a need for further policy support, while others are saying that rates are already at historic lows, and this growth picture of 5%, that target will be met, if not will be beaten handily. And so therefore policy easing won't be coming for some time. And then you have every other argument kind of in between, like all over the place, right? I personally, I'm not an economist, and I don't know, all right? However, I will say, if you recall from earlier this week on Market Depth, when I talked about China's total debt to GDP ratio hitting new record highs, if you recall that was due to a surge in credit growth for the January to March quarter of this year. Okay, so there was already a surge in credit growth during that time period. So given that very recent backdrop and context, the PBOC probably might not be in an immediate rush to fill the punch bowl. What the hell do I know, though? Either way, further confusion and contradictory data, right, as to the broader China story, the reopen story. But as I've been saying all along, you really do have to kind of be able to separate, compartmentalize everything, right? There is no such thing as a monolith in the world's most populous country. The wealthy are reopen consuming. And what are they consuming? What the wealthy people consume. Luxury goods, services, all that kind of stuff, right? The non-wealthy are not. So it is very possible to have a simultaneous reopen activity happening and not happening in a population of over 1 billion. The younger generations are not doing it either, right? Nor are they rushing back into reflating a housing and property bubble. They're actually currently being very conservative with their savings. But that said, any and all this can turn on a dime in any direction for any reason. So, therefore, we need to be relentlessly vigilant, because if the developed world enters a recession, then China's economic activity will have to bail out the rest of the world. And if they instead join in with being an economic drag, then that's the difference between a so-called mild recession and a far more prolonged, self-perpetuating, self-feeding one. Things like commodity price action and stuff like that, I mean, you're seeing why you have crude oil that has yet to have its 100 handle and above surge in this supposed China reopen outlook that so many people had. I mean, how long can a reopen window last for, right? So that's another way of almost saying that it doesn't make sense to buy crude oil call options like leaps or with very far out expiries. Because if it's going to happen, it's going to have to happen sooner than later, if that's your thesis. Okay, G7 finance ministers and central bankers gather in Niigata, Japan. And they're doing this currently, and they're doing this ahead of the main event, which is G7 Hiroshima. That's next week. So currently, Christine Lagarde is walking around here somewhere. Actually, Niigata is not at all close to Tokyo. It's like a ski town. I didn't even know that it existed in non-winter months. But it's not just Christine Lagarde, okay? By which I mean, so the G7 is the U.S., Japan, UK, Canada, Germany, France, Italy, right? Yeah. Plus the European Union, but this time, apparently in a kind of rare move, G7 has invited some non-members, such as Brazil, India, Indonesia, South Korea, Singapore, as well as the chair of the African Union. So invites have been brought out to join part of the G7 meeting in Japan, supposedly to discuss matters including global matters like debt issues affecting the lower and middle income nations. That's what kind of the official stated reason is. And then the unspoken but still kind of blatantly obvious other reason being to kind of coalesce against China economically. But the official agenda for the G7 finance ministers and central bankers for 2023 Japan, first on the list is inflation. Ironically, being held in the one country that's lacking or lagging inflation, and either way is just full-on pro-inflationary central bank policy. So kind of awkward for Japan officials to be standing around when everyone else is having that conversation. So that's issue number one. Issue number two is Russia sanctions, and how to kind of enforce sanctions and to push back against those who evade. And then after that is global financial stability amidst banking crises and so on and so forth. And then after that is China economically. So that's what's supposed to be going on. That's what they're supposed to be working on, discussing. That's what they're here for. Now, what's actually going on? Everyone is encircling Janet Yellen, asking if Congress is going to default on its obligations, or if this is just another stupid Washington Highwire Act. And either way, if they can all please just get live updates. If this is theater, or if we're really going to do this, please just let them know as soon as you know. Now, here's some color from on the ground, okay? As in from Japan. I'm not, like I said, I'm not in Niigata, as I mentioned. It's not close by. But just kind of from a media sense, right? From the host country media sense, coverage wise, you know what what the prevailing G7 headline has been in domestic general Japanese media? It's nothing about what these people are actually discussing or doing or working on or press conferencing or anything like that, but rather it's that U.S. President Biden might be a no-show to G7 Hiroshima next week because he may have to potentially be in D.C. to hammer out a debt ceiling deal. Now, that headline alone is just very bad for America, let alone if Joe Biden actually didn't attend G7 with the rest of the world leaders because he's home talking to House Speaker Kevin McCarthy about paying bills that they owe on money that they already spent and messing with the so-called risk-free credit of the U.S. Treasury. The latest headline development on the matter, from what I can see, right, is that Biden and McCarthy postponed their debt ceiling meeting set for today, Friday, to next week. Okay, so at the time of this recording, this is where we are, and that's supposed to be a sign of progress towards a deal being made. Okay. Well, history shows that these modern debt ceiling showdowns don't get resolved until the 13th hour, so it most certainly will continue into and past next week unresolved. Like, that much I can be fairly confident of saying. So, debt ceiling issue will overhang until the last minute, and then maybe even beyond that. Okay? And so, therefore, next week it's not going to be solved if Joe Biden stays or if he doesn't stay. So it's now just a matter of whether or not President Biden actually cancels his G7 and his Quad appearances in Asia, and if he is a physical no-show. And if he is a physical no-show, in my view, that would only be bad for everyone. G7 and G20 gatherings themselves, they don't really matter so much in terms of like geopolitical developments and potential shocks or whatever it is. Like, the real action is like the impromptu bilateral or otherwise like talks on the sidelines that just kind of happen off camera spontaneously that shape the global picture, have more influence on that, right? So if the United States president is a no-show Zoom call-in in a critical region of the world where every other major leader has physically congregated, has to Zoom call in from DC, all because American politicians can't seem to refrain from being clowns in a lunchroom food fighting just to pay its bills, then it's not just a debt ceiling matter anymore. It's not just full faith and credit of the United States government anymore. Because even if and when the debt ceiling gets lifted, the president of the United States has ceded away, some leadership or credibility at a time where there's really not it's not such a given anymore, right? And I'm not talking about specifically just Joe Biden. I mean the presidency of the United States, regardless of the occupant. And then after G7 Hiroshima at the end of May in Sydney, Australia, there's a gathering of what's known as the Quad, right? So it's leaders of Australia, India, Japan, United States. Those four are set to hold a summit. It's called the Quad, and the discussions of like how to deal with China's increasing military and economic influence teamed up, right? Australia, United States, Japan, India. So, Quad, -1. Like, I mean, how seriously would anybody take American leadership if the president can't leave home because Congress might default on U.S. debt? And by the way, he should be home trying to hammer out a deal and avoid a catastrophe rather than attending the G6. And the G6 would prefer that as well. What I'm saying is that is just a very pathetic state of affairs for the United States to shoot itself in the foot already, and in more ways than one, in far more than just like economically. Like, it reverberates far beyond that, right? And so that's why this like general Japanese broadcast media, at least from what I can see, like the story thus far that Joe Biden may be a no-show, that in itself already weakens the United States standing. That such a thing like missing the G7 for what should be a routine thing for the U.S. to not default could even be conceivable. Okay, so that's all for the G7. I'll keep you guys posted if I see anything else anecdotal or otherwise that might be missed. As long as I'm here, why not, right? Or as long as they're here, why not? Oh, by the way, I keep getting asked this question for some reason, like a lot recently. I don't know why, but for those of you who want my view as to what I think would happen to the markets should there actually be a United States like default triggered, like an actual one, my answer is, first of all, whatever I say is under the pretense that I have no effing idea what the cascade of market dominoes would be. Nobody does. And so this is going to be a very hypothetical, nonsense response of zero value. Okay? But if that's what you want to hear, okay, it's my view that if the United States doesn't pay its obligations in full and on time and actually has like a credit event like a default, right, then markets-wise, I think what happens is that dollar yen, USD JPY, and US yields would absolutely plunge together in tandem. Because in a US default financial meteor striking scenario, the relative safest haven inflows amidst global cross-asset mayhem would ironically find themselves diving into U.S. treasuries. Those are still the relative safe havens in the given sort of Armageddon scenario of, markets, right? Cross-asset. So despite being the very instrument that just defaulted, that's what I think that's what happened, and so that's why U.S. yields, especially at the long end, would collapse. And then currency-wise, as USD is a safe haven, from everything, the perceived safe haven from USD in a risk-off scenario is the yen and gold, and maybe CHF. And so U.S. defaults, then U.S. Treasury yields, and dollar yen gets smashed in my view. But who the hell knows? All right, finally, to wrap things up for markets this week, okay, just wanted to follow up with the commentary I was making, earlier in the week to see how they panned out, right? So first on the broad-based indices, so the last episode of Market Depth, for which the thumbnail of the episode for YouTube, like the image literally said something along the lines of like, China crashes as Japan rallies. It's as straightforward as you can get for my view at the time. Basically, what I was noting was that I think that based on kind of the market trading behavior in these Chinese stocks that were going limit up on the Chinese like bank stocks starting on Monday, and the kind of concentrated one directional buying that were happening in specific incremental times, of the trading day, right? Market on open, PM open, the PM close. And this is all following the prior day's limit up halt on certain Chinese financial shares and state-owned enterprises. Like what I was saying was that so we're going to get a sharp pullback when this nonsense momentum rally in state-owned bank stocks suddenly reverses, and that reversal just occurred 30 minutes into the PM trading session, earlier that day. And it's broad-based China equity markets downside in the immediate term from here forward. That's what I said in the last episode. I also then, in a completely separate matter, said that the Japan markets are currently holding up at a level of resilience that's extremely rare that I don't really see. There's actual inflows, and not only are the Topics Index and the Nikkei Index the best performing major DM indices year to date, hitting new 52-week highs every day or every other day on pure foreign capital inflows, but this like long Japan and short China setup is going to be starting in the immediate, is what I said. Okay, so what happened in the immediate? Just to follow up. So the China CSI 300 index from that moment was consecutively down over 1% per trading day since then, and down 3.6% from that Monday limit up meme day to close today. And it wasn't just China, it was Hong Kong that was also dragged down 3.3% in just like the 3 trading days since to the end of the week, right? Taiwan was down 2%, Korea was down 1.5%. Australia was, I think it might have ended the week slightly down, or more or less flat to the end of the week, right? So it was regional. Japan, over that same exact period, the Nikkei is positive like 1.6%. Look, for those of you who don't know me or haven't followed me for very long, I just want to let you know I am never, ever, ever bullish on the Nikkei or the Topics Index or the Japan Equity Index indices as a relative pair. Okay, as in, when I say I'm never bullish, I'm not saying that I don't think that they'll ever go up. Obviously, they will go up and go down too. When I say relative pair, I mean that if I had to do a long Japan and I had to short another major global index, I would never do that, because even if I think the Nikkei will be going directionally higher, it will underperform whatever that short pair is, regardless of what it is. SPX, the DAX, whatever it is, right? That's what I mean by I'm never bullish on the Nikkei or the Topics Index as like a relative pair. I can count maybe like 5 times that I was definitively long Japan. In like that kind of relative pair trade setup over the past several years, maybe 5 times. Okay. Now, I'm not saying that I have that level of conviction currently, but it is getting close to that. It's all about that Nikkei at that 30K ceiling level of resistance that it's approaching. If we blast through that, like, I mean, I'm long, okay. Or I'd add to my long, okay. But look, don't listen to me in my trading nonsense or whatever, right? My point here is just to simply and clearly, state for the record for any new followers of mine, and just to let everyone know that I am never bullish the Nikkei index, just historically, um, for many good reasons, right? And if I ever were, I would hope that you would take it as pure objectivity behind me being bullish and absolutely nothing to do with my geographic location or something like that, right? I would hope that I've instilled enough of an impression that like geographic bias or any irrelevant bias is absolutely not part of my market interactions. So, if you're just familiarizing yourself with me, and then I do happen to really step up being bullish on Japan equities in like the near term, like you've simply caught me at a rare kind of coincidental moment. Okay, just want to let you know that. But right now, there are serious foreign inflows going into Japan, and look, they can just as quickly and easily be outflows, but a foreign inflow led breakthrough through that 30K resistance on the Nikkei index would probably be the most like bullish flow driver for that index and for any really major DM index that I've seen in years. Okay, now let's just follow up with the single stocks from earlier this week. Okay, so remember JFE Holdings? This is the Japan steelmaker who reported, very strong guidance and had a 15% intraday rally after their earnings on what was it, Tuesday, right? And because they guided for huge steel production increases for this fiscal year, because because they're getting demand from the automotive sector, which they supply to. And why is the automotive sector in need of JFE metals? Because if you can recall, according to JFE's earnings statement on Tuesday, the automaker's semiconductor chip shortage has begun to normalize such that they can return to auto production like capacity. Maybe not full capacity, or maybe so, but either way, more than they were being limited by due to this lack of chip supply. In charts that I was looking at was that Japan steelmaker JFE Holdings shares and the SOX Philly Semiconductor Index were pretty well correlated directionally. A steelmaker in Japan and the U.S. Semiconductor Index directionally correlated. Okay, if you haven't seen this episode, by the way, it's the last one, so go take a look at it and you'll see what I'm talking about. Consistently like directionally correlated for like a decade, right? And then the second point was that as of late, JFE Steel shares, as well as the Topics Auto Sector Index, which is basically like Toyota, Honda, Nissan, that those move like in percent for percent lockstep, and the car companies. That would mean that the fundamentals of the company were actually kind of being reflected in markets, right? Because if the autos are doing well and they're making cars, then JFE Steel does well, providing material to make cars. It's very straightforward, and vice versa. So that's why I pointed out to keep eyes on Nissan and Honda earnings after market yesterday, on Thursday, in case that what JFE management was already saying in their earnings just 2 days prior that their automotive customers are back with orders to make cars due to the easing of semiconductor chip supply situation, which led to JFE shares rallying 15% intraday. That it's very highly possible, if not likely, that Nissan and Honda may very well echo the same exact thing in their earnings 2 days later. Okay, well, what happened at their earnings? Let's take a look. Nissan Q4 22 earnings for this quarter that just ended in March, okay? We have a net profit that came in 7 times higher year over year. 7x higher. Last year, net profit 14 billion yen. This year, 100 billion yen. What's more, however, okay, Nissan's guidance for the fiscal year through March 2024 is for sales of about 12.4 trillion yen, which, if they hit that sales figure, that would be a record for Nissan. So, Nissan is basically guiding for record sales. Why did Nissan kill it this last quarter out of nowhere, right? 7x their profits so year over year. And more importantly, why are they extremely optimistic on their sales guidance, to a record level? Well, according to Nissan president and CEO Makoto Uchida at the Thursday yesterday's earnings event, quote, "It's a tough environment, but production volume will grow from our new models and the recovery in the semiconductor supply chain." Honda, quote, "We expect global sales to increase 18% to 4.35 million vehicles for a year ending March 2024, says Honda Executive Vice President Shinji Aoyama, also on Thursday, predicting the semiconductor supply to recover towards the second half. Operating profit was projected to grow 90% to a record 1 trillion yen. A rebound in production is anticipated, improving the utilization rate of Honda's plants. It's not like JFE is just making shit up out of nowhere. They literally gave a 2-day advanced heads up into Nissan and Honda's earnings, but markets hadn't made that connection with the Nissan, flat on the day, right before they reported their earnings after market. So what I was thinking was like, look, if Nissan shares surge tomorrow at Japan Cash Open, or even overnight on US ADRs, okay, though obviously the Japan listed shares are really what matters, but if that happens, that says a lot about a lot, okay? But mainly what it says is that markets are absolutely not efficient and fully priced in. They just aren't, okay? Which is another way of saying institutional investors, the pros, they very much miss shit that's out there in the open. And we, the individual investors, aren't always and permanently without edge just because they exist out there. Okay, so it's a broader message that's bigger than JFE Steel or Nissan or Honda's earnings plays or anything like that. It's just a very simple message of do not be intimidated by institutional investors thinking that they are pros, okay? And that you have to put your capital up against people who do this for a living, with resources, with time, with this is their job, and they have the experience, and they have the capital, and they have the access to this and that or whatever, and this is a zero-sum game and you're gonna get destroyed. I guess it's totally justified, like why you would be intimidated. Those fears, which I used to harbor myself, they simply aren't true. They aren't, right? Like, the reason I'm talking about this JFE Nissan and Honda trade, it's not because I'm like patting myself on the back for like any purpose like that. No, I have to grasp this opportunity to show you in real time on the record that these things are not priced in. JFE Holdings management said 2 days before Honda and Nissan earnings what Honda and Nissan earnings are going to be saying. Markets didn't react to it. They reacted today to it. Both those stocks closed up 5% on massive volume. They pushed the Japan index up. So I have to seize that moment to prove it to you that markets are not efficient, that the institutions missed that completely. Obviously, that's why they ran in today. And that this is a common occurrence. And so I hope that will instill some confidence, or maybe even rejuvenate interest and enthusiasm for markets, and to try to figure things out. And that, yeah, you do have a shot. Yeah, you can have an edge yourself. And of course, all that's possible. That's why I'm showing it right now. seize the moment to do that. And it's rare that I get shit right too. So anyway, thank you for following and listening to Market Depth. On behalf of Blockworks Macro, my name is Weston Nakamura. Have a wonderful weekend. Keep an eye out for this SoftBank thing, and we'll see you soon. Thanks.